I try to read 1 to 2 books a month every single year, and I've been doing this consistently for 10 years now. Out of all the business books I've read, I have one that stands out as my favorite. So my favorite business book of all time so far is the one that I recently finished, and it's this one here called The Road Less Stupid by Keith Cunningham, advice from the chairman of the board. Now this is a phenomenal business book, but it also has great insight and wisdom for real estate investors, particularly from chapter 10. Now that's why I first picked up this book in the first place. I heard it from Brandon Turner on Bigger Pockets, which is a real estate podcast, and he recommended that chapter for investors. So I picked it up for that, but I ended up reading the whole thing because it was such a great book, and I recommend you do the same. So today I'm going to break down the highlights that I found were the most useful and insightful, and I'm going to share that with you guys so you don't have to read the whole book, but I still highly recommend you do. All right, so this book is pretty much about avoiding dumb mistakes that sabotage growth, profits, and business success. It's the lessons that Keith Cunningham has learned from personal experience over 45 years of business and investing experience. So he talks about the mistakes he's made, the lessons he's learned that's cost him millions of dollars, and it's really insightful. And what's great about it is the chapters are super short, only a few pages long per chapter, so you can just do one chapter a day in 5 minutes or less. And at the end of each chapter and in the middle of it, he has like these little bumper stickers, which are like the main ideas of the chapter to stick with you. So I'm going to go through the things that I thought were the most insightful. One of these to start with here is talking about investing, the power of 3. These 3 questions should be asked prior to making any major business decisions and investment activities. Number 1, what is the upside? And number 2, what is the downside? And number 3, can I live with the downside? All right, here we have another one. The single best business decision you will ever make is to intentionally work with a peer group on a regular basis to question assumptions, ask hard questions, the kind you hope nobody will ask, alert you to icebergs, raise the bar, and push and hold you accountable. Here's a bumper sticker. Anyone who says customers are number one has lost their mind. Employees are number one. Employees are the source of all value creation. Show me a disinterested employee and I'll show you a lousy culture, a weak leader, and a poor customer experience. In the final analysis, truly caring about the people is what drives and sustains culture, and culture drives value creation. So he really emphasizes the importance of culture. Let's see what else I have. This is from chapter 10. Now this is the chapter I was telling that you should read if you're a real estate investor. He talks about the crisis in the 1980s, as there was a huge downturn and collapse in the real estate market, and he lost a lot of money. So he basically logged his lessons, and he has subcategories for each with strategy, deals. Like for an example, doing a deal to keep the staff busy is stupid. A bad economy doesn't create financial problems, it just reveals them. Financing, debt gives the illusion of wealth. True wealth is assets, cash flow, and manageable minimal debt. Personnel, overhead, and at the end of each chapter you'll see there's a thinking time, which is basically questions to ask yourself. He emphasizes this in the book. Take time to think about the right questions, and it will give you the best return on that investment in time. That's what's going to help you clarify what you need in these chapters, the thinking time portion. All upsets are simply unmet expectations. That is definitely true. So you want to set the expectations right with your employees and your customers. In your life, you are the CEO of you. You are the only person responsible for all these areas. Unlike most CEOs of a business, however, you do not have a board of directors of You Inc. that you report to. But what if you did? What if you had a board that had followed you around all day, every day for the last 7 days? They had seen every click of your mouse, the level of intensity of your focus, and how you planned and prioritized your work. They had seen everything you did as CEO of You Inc. Ask yourself this question. If I had a board of directors, would they give me a raise or would they fire me? If You Inc. were a publicly held company with stockholders, would your stock price be rising, falling, or treading water? Hell on earth would be to meet the man you could have been. I want to be able to meet the guy I could have been, look him in the eye, and say, I know you because I am you. Not all risks are created equal. He has a great little chart that he breaks down in this chapter. And he says all risks have 3 moving parts: the probability of the risk occurring, the cost if it does occur, and the manageability or controllability of the risk identified. You can create this chart for yourself to kind of get a visual of the risks involved in an opportunity or decision made. And he says if they're clustered in the upper right-hand corner, that you should run away and it's way too risky of a deal. The average small business sells for less than 3.5 times trailing annual earnings. This is talking all about how to exit your business and create the biggest value for the highest price. So the greater the predictability and sustainability, the greater the enterprise value, and thus the more attractive it is to a buyer. Being aggressive with expansion is always risky, especially when a stable foundation is not in place. The management team is not solid, or you are relying on the capital structure, excessive debt, to produce the returns required. Doubling the horsepower of the engine in your car or substituting rocket fuel for your unleaded gas will not enable the car to go 2 times faster. Scaling mediocrity produces bigger piles of mediocrity, not success. Always optimize first. All business owners want to grow, but few have the discipline to create a sound platform for that growth prior to pouring in the jet fuel. Growth is what you say yes to. Success is what you say no to. The hardest thing in business is figuring out what to say no to. Warren Buffett said it best. The difference between successful people and very successful people is that very successful people say no to almost everything. I erroneously believe that the higher the risk, the higher the reward, which is just plain stupid. The correct statement is this: the higher the risk, the greater the likelihood of a loss, not a reward. Here is the real secret. The chance of success goes up when you think, plan, consistently execute the right things, and worry about the possibility of loss. Someone always seems to have more. In an effort to feel good about ourselves and our ranking, we think the goal must be more, even though what we have is beyond most people's wildest dreams. This I thought was really interesting. If the world were a village of 1,000 people, 350 are malnourished, 330 live in a shanty town with no running water or central sewage disposal. 250 are illiterate, they can't read or write at a first grade level. The median income is $3.30 a day, and 10 make more than $34,000 a year, which is the top 1% in the world. So this helps you put things into perspective and how rich we are as a country. Feeling gratitude and not expressing it is like wrapping a present and not giving it. At the end of my life, I will only ask 3 questions. Is the world a better place because of me? Who loved me and who did I love? Was my life congruent with my beliefs? Which is the ultimate definition of integrity. Here it is on a bumper sticker. Pleasure is about stimulating the senses. Happiness is found by being grateful for what I've got. Success is getting what I want. Fulfillment is giving what I've got. I thought that was really powerful and a great way to end the book. He then has an appendix which has really great summaries of everything. I'll give you some of the ones here. It turns out that the key to getting rich and staying that way is to avoid doing dumb things. I don't need to do more smart things. I just need to do fewer dumb things. I need to avoid making emotional decisions and swinging at bad pitches. I need to think. So you can see he has a lot of the protecting the downside, thinking about loss, being conservative. That's how you save and continue to grow your wealth, along with a little bit of aggression. Ordinary things consistently done produce extraordinary results. Think about the discipline of consistently reviewing your prior month's financial statements by the 10th of every month. In a matter of a quarter or two, the insights and optics harvested will change the priorities and decision making in your business. Start with what customers want. Start with their needs, desires, and pain. Start with the gap between the solutions being offered by the competition and where the customers, are frustrated. You are running two businesses simultaneously, the one that is providing revenue today and the one that will generate revenue tomorrow. It is highly unlikely they are the same business. Have a granular understanding of what your competitors do and how what you do is meaningfully different. You must be able to tell a customer, this is what we do and here is why this is important and unique. Other vendors do not do this. They do that. If you want that, you should buy from them. If you want this, you should buy from us. You and your customers are in a relationship. Relationships tend to work best when the focus is on meeting the needs of the other party, not our own. Oh, I skipped here. Not all progress is measured by ground gain. Sometimes progress is measured by losses avoided. When you think about what could go wrong, you dramatically increase the odds of creating something that will go right. It makes no sense to try to get more when you are not optimizing what you've already got. I'll repeat that, it makes no sense. All choices require a trade-off and sacrifice. You can have almost anything you want. You just can't have everything you want. Operators react in sweat. Owners think and plan. Doubling the horsepower of the engine in your car or substituting rocket fuel for your unleaded gas will not enable the car to go 2 times faster. Scaling mediocrity produces bigger piles of mediocrity, not success. Always optimize first. I think I underlined this one twice. And that's pretty much it. The end of this is just some more resources in the appendix. But that was the majority of the highlights I had from this book. I hope you got some value from that quick overview of the book. Please read chapter 10 if you're a real estate investor. You're going to get a lot of value from it. I know I did. Thank you for watching today's video. Please subscribe to the channel if you haven't already. If you like stuff like this and you want me to do more videos, please let me know. I appreciate the feedback. Like always, keep going, keep learning, and keep grinding.